Imagine a dam holding back a massive river of consumer spending. Behind it, millions of Americans itching to spend, but held back by sky-high interest rates. Now imagine that dam about to crack. Hey Bowtie Nation, Joseph Hogue here, and what we're about to see could be one of the biggest consumer credit booms in decades. The Federal Reserve is preparing to slash interest rates, and that one move could unlock trillions of dollars in lending and spark a surge in credit card usage, personal loans, and fintech adoption. And when that flood of easy credit hits, the companies that are ready, the ones best positioned to lend, charge fees, and ride that wave are going to soar. I'm talking 5 stocks that could ride this rate cut cycle to massive gains. You see, the past 2 years, interest rates have been the fun police of the American economy, crashing the party just as it was getting started. In 2022, the average credit card APR was around 16%. Today, it's more than 22%, the highest in decades. Now that 6% jump might not sound like much, but for consumers, especially lower income households, it's the difference between swiping a card for gas and deciding to skip dinner out entirely. It's not that people don't want to borrow, it's that borrowing has gotten too expensive. And the data backs that up. Credit card balances are still below 2008 levels when inflation adjusted, and households are spending just 11% of their disposable income on debt servicing, far below the 2008 peak of over 15%. In other words, Americans have the capacity to spend, they just can't afford the rates. Meanwhile, delinquency rates, the percentage of people falling behind on their payments, have begun to fall. According to Truist Securities, net charge-off rates declined year over year for the first time in 3 years. That is a big deal. It tells banks that consumers are becoming less risky, even as spending is still held back. And that's where the Federal Reserve comes in. With inflation down from the 2022 peak and the jobs market shaky, analysts expect rate cuts to start again when the Fed meets in September. Those cuts are going to directly reduce the cost of credit card debt and other consumer loans. That's because credit card rates are tied to the prime rate, which follows those Fed moves. A 1 to 2% drop in the Fed funds rate could push average credit card interest down towards 19% or even lower. Now, that's not cheap, but it's a heck of a lot better than the 22% right now. That kind of drop could unleash a wave of new borrowing and spending. And it's not just the traditional banks that are going to benefit. Fintech lenders like SoFi and buy now pay later platforms like Affirm have been hit hard by those rising borrowing costs. They operate in tight margin systems where every basis point matters. When rates drop, their entire business model becomes more profitable. So combine cheaper credit, stronger consumers, and loosening capital requirements for the banks, and you've got the perfect cocktail for a lending boom. So let's look at the 5 stocks that could thrive in this environment and why each one has a unique edge over its competition. First up, Capital One Financial, ticker COF, in a great place just coming off its acquisition of the Discover network. In the high rate environment, Capital One tightened lending standards like most big banks. The share of new card accounts going to subprime borrowers dropped from 23% to 16% between 2022 and last year. That move improved credit quality, but it also slowed its growth. And now that cautious lending could pay off. As rates fall, Capital One is in a perfect position to reopen that credit spigot. CEO Richard Fairbank recently told analysts the U.S. consumer is in a great place, and second quarter data backs him up. Vehicle loan delinquencies fell, credit card charge-offs declined year over year, and the company is still growing. Those lower interest rates are going to improve Capital One's net interest margin, the NIM, that spread between what it pays to borrowers and what it earns from its customers. In a falling rate environment, banks lock in that funding at lower rates while still earning strong yields from existing loans. And that means a lot of profit. And Capital One here has something a lot of the fintechs don't, a massive deposit base. Now those low-cost deposits give it a competitive edge as borrowing costs fall. That means it won't have to borrow from capital markets at higher rates. It already has the funds. And the addition of the Discover Card network opens up new revenue, potentially moving Discover Card members into banking and business with COF. It's also cheap when looked at as a card company with a P ratio of around 14 times versus almost 20x valuation for American Express and 28 times for Visa. The company's 3-year revenue growth stands at nearly 19%, and shares have returned 43% in the past year. If rate cuts do spark a consumer credit surge, Capital One is going to ride that wave higher with both growth and profitability to show for it. We'll get right back to those stocks to watch, but if your Mac has been a little sluggish lately, it's not your imagination. Over time, it collects junk files, caches, and hidden space wasters like your weird uncle collects comic books that are going to someday be worth a lot of money. For that, I want to thank today's sponsor, Clean My Mac. Created by MacPot and notarized by Apple, Clean My Mac is the all-in-one toolkit that keeps your Mac running like the day you unboxed it. With just one click, it clears clutter, optimizes performance, and scans for malware, so you don't have to juggle 5 different utilities. The newest feature, Cloud Cleanup, dives into your iCloud, Google Drive, and OneDrive to find files you forgot about, and it's scanned locally, keeping your data private. Even if you've never been a victim of a hack, Claim My Mac adds peace of mind with real-time malware scanner, protecting you from the real threats that slip past. Think of it as having your own personal IT department living in your Mac. Boost speed, cut costs, and get your Mac tidy today. Try Clean My Mac for 7 days free, and because it's not just about speed, but getting a good price, use my code JosephHogue for 20% off. Back to our stocks and switching it up from traditional credit to fintech with one of my favorites, SoFi Technologies, ticker SOFI. Now, SoFi has always marketed itself as the anti-bank, sleek apps, fast approvals, and millennial-friendly interface. But here, SoFi isn't like the other fintech leaders either, in that it actually has a banking license and can operate like one. That is a huge difference because it means the company can hold deposits, creating cheap sources of funding for lending, along with offering all those traditional services of a bank. SoFi's business model depends on scale, acquiring users, cross-selling loans and investment products, and then growing engagement. With interest rate headwinds easing, that model could finally accelerate. According to the data from the Fed, total credit card lending is growing at just 3% year over year, but SoFi's 3-year revenue growth is a blistering 38%. Shares are up 42% in the past year. Rate cuts could push that even higher. And again, unlike Affirm or other fintechs, SoFi isn't limited to just one type of lending. It offers personal loans, credit cards, mortgages, student loan refinancing, even investing tools. That diversity means more ways to win as rates drop and consumers re-enter the borrowing market. Now, we've still got 3 more stocks to buy before this credit boom takes them higher, but I want to show you the most important measures to watch for here if you're going to be investing in these types of banking and credit card related stocks. That's because, nation, every industry has 2 or 3 metrics that are your clue into which companies have that competitive advantage that's going to translate into higher returns. Analysts spend their careers learning these, but I'm going to show you them right here. First up here, net interest margin is the most important, the lifeblood of lenders, because it measures the difference between what they earn on their lending versus what they pay on deposits. This is that core profitability for a bank or any credit company, so you want to see this trending higher. Here we see a giant jump in the net interest margin for Capital One in the last quarter, up to 7.6% from under 7% in the quarter before, and then trending higher over the past years. Now, maybe I should back up a little bit for any of these, and really one of your first stops to analyzing a group of stocks. You need to go to the investor relations page for each company, then find the company's presentations. You can go to Google and type in the name of the company plus investor relations, a page every publicly traded company is required to have. On this page, you're going to find all the financial reports, press releases, and news on the company, plus either an investor presentation or one of its last quarterly reports. In this, you'll find these industry-specific metrics and a lot of other data. And besides these critical industry-specific metrics that we're talking about here, a lot of these presentations are going to show you the big picture growth factors, what's really pushing the entire industry. So it's a great resource for your research into the theme. Just as important here is what a company doesn't say, though. If you notice, all the other companies in the group are talking about one measure, say this net interest margin, but one company is deceptively quiet on it. That's your clue that something might be wrong there. And yes, I know this is a hell of a lot more work than just letting some Yahoo in a bow tie tell you what stocks to buy, but nation, if you're going to be investing your own money, don't you think you should do it right? Now, I'm doing the research on these stocks, but what about all the other channels with their promises of turning $75 into millions and that easy money investing? Now, back to those critical lending metrics, though, and next is the charge-off rate, the percentage of loans a lender has to write off as uncollectible. Now, this is a direct window into the borrower's credit quality and how well the lender has managed its own lending standards. A dropping charge-off rate suggests improving credit quality and is going to flow into those profits. Here we see Capital One has been able to lower its charge-off rate to just 5.2% from 6% a year ago, a great sign going forward. And then closely tied to that charge-off rate, really a preview to it, is the delinquency rate, measuring how many borrowers are late on their payments. Most lenders measure this as a 30-day and 90-day rate before charging off those loans, with COF seeing its delinquency rate fall from 4.1% last year to 3.6% in the most recent quarter. That is another great sign for profits and shows what I'm talking about in this video. Consumers pulling back on borrowing in the face of those higher rates, but improving their credit quality and getting ready for that spending spree when rates do come down. One final measure here before we get back to those stocks, the price-to-book ratio and how to value these bank and lending stocks. While investors generally like those price-to-earnings or the price-to-sales ratio to compare stocks, seeing which are better deals or more expensive, it's the price-to-book value that you want to use for stocks in the financial sector. That's because these companies hold their assets, the loans they make, and then the liabilities, the deposits they hold on their balance sheet, so it's a clearer picture to what the company is actually worth. By looking at this price to book value, you can see how expensive the stock is, how many dollars in price investors are paying for every dollar in actual book value of the stock. For example, with Capital One, we see investors are paying $1.20 for every dollar in book value, a price to book of 1.2 times. And then within this, there's some things you want to watch for. First is, what is that price to book compared to the company's history? For COF, that 1.2 times is lower than the valuation just a couple of months ago in June, so a discount there, but it's above where it's been for most of the past year. That would imply that right now, shares of Capital One are relatively expensive compared to where they've been in the past. Investors are paying more, 1.2 times book value, than they have in the past. But then you also want to compare that price to book value against its competitors. Here we see that SoFi, for all its growth and all the money it's made us already, it is just so damn expensive at a price of 3.7 times book value. Nation, when I first started recommending SoFi, it was trading at just 0.8 times book value, a steal, and has jumped 273% since then. And while that growth should continue, and I still like the stock, especially in this low rates theme, this 3.7 times price to book is just very expensive and puts that 1.2 times price to book for COF into perspective. Maybe a little expensive, but not such a bad deal. Back to those stocks to buy, and buy now, pay later giant Affirm Holdings, ticker AFRM. Affirm is the poster child for the buy now, pay later BNPL movement, and arguably the company hit hardest by those rising rates. That's because BNPL companies don't make most of their money through interest. They make it through merchant fees and then those installment loan economics, which really only work when funding is cheap and people are spending. Over the past 2 years, Affirm's cost of capital exploded and profitability evaporated, but with rate cuts on the horizon, that dynamic flips. According to Liberty Street Economics, the average APR for new credit cards on subprime borrowers hit nearly 28%. That opens the door for BNPL alternatives like Affirm, especially when they can offer that 0% or lower interest installment plans in partnership with the merchants. So if a firm can borrow cheaper when rates fall, offer better terms, and keep delinquency low, its unit economics improve fast. Its revenue has grown at 25% over the last 3 years, and shares are up a whopping 145% in just the last 12 months. But then it's not just rates here. Affirm has deals with Shopify, Amazon, and Peloton, putting it directly in the path of e-commerce growth. As consumers feel more confident and spending rebounds, Affirm can benefit from both increased transaction volume and improved margins. Now the big question for this one is regulation. BNPL is still lightly regulated, but as that industry grows, expect more scrutiny. Still, in the near term, rate cuts could provide that powerful tailwind, just as Affirm works towards its consistent profitability. Next is an interesting one we haven't covered before, Bread Financial, ticker BFH, absolutely tiny at just $2.7 billion market cap. Now, Bread Financial doesn't have the same household name recognition of Capital One or SoFi, but make no mistakes, this is a quiet contender with some surprise upside in a rate cut cycle. That's because BFH is a pure-play consumer finance company focused heavily on that private label and co-branded credit card programs. Think store cards for major retailers like Victoria's Secret, Wayfair, and the NFL Shop. When borrowing gets cheaper, retail spending tends to bounce back, and Bread is going to ride shotgun on the resurgence. Its advantage is a highly targeted, high-margin portfolio. Unlike the big banks trying to be everything to everyone, Bread Financial focuses on specific partnerships and verticals, allowing it to manage risk and profitability with more precision. Right now, that business model is constrained. The company's average borrowing cost has climbed with interest rates, squeezing margins and slowing that new account growth. But if rates fall, Bread's funding costs improve fast. Net charge-offs and delinquency rates have already begun to decline, signaling healthier customer behavior. And while Bread's 3-year revenue growth has been more modest at just 4.2%, the stock has still returned over 16% in the past year. Bread's smaller size with a $2.7 billion market cap also means it could have more upside potential in a rebound scenario. It doesn't need the entire economy to roar back to post strong numbers. A few favorable rate moves and a retail rebound could make a big difference here. So for investors looking for a more leveraged play on this credit card spending without the size and complexity of a mega bank, Bread Financial might be one of the most interesting names in the space. From the smallest to the largest here with powerhouse Mastercard, ticker MA, at a $511 billion market cap. Now, Mastercard isn't a lender, and that's exactly why it thrives in moments like these. Unlike Capital One or SoFi, Mastercard doesn't carry consumer credit risk. It just processes those transactions. It collects fees every time you swipe, tap, or click, no matter what you're buying, diapers or designer handbags. So while interest rates impact credit card usage, Mastercard is protected from the worst of those consumer credit downturns. But then here's where it gets interesting. Mastercard also benefits on the way down. As borrowing gets cheaper, credit card usage increases, and Mastercard is there to skim a small fee off every transaction. With consumer credit usage poised to rebound on these rate cuts, Mastercard could ride that wave without worrying about the charge-offs or the delinquencies. That makes it a relatively safer play in this space while still offering upside. Even in 2024, during one of the toughest rate environments in decades, Mastercard delivered consistent revenue growth and profitability. That's the power of this toll booth business model. It gets paid no matter who wins. As rates fall and consumer optimism returns, expect Mastercard's volume to climb. It might not deliver the wild upside of Affirm or SoFi, but it brings stability, scale, and consistent returns, all while tapping into this same trend. Look for the link in the description. Try Clean My Mac free for 7 days and use my code JosephHogue for a 20% off. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.